Have you ever caught yourself thinking or saying, if only I'd done this, or if only I'd done that? You know, that deep-seated feeling of regret when you miss out on an opportunity and then kick yourself later as you keep saying to yourself, I should have, and I could have. Now, sadly, this is a common thought and feeling in the world of property, because you can always find 1,000 excuses why you shouldn't buy a property, because you can always find a reason why it's never the right time. But as you're about to hear, it comes at a considerable cost. So what is the cost of missed property opportunities? Well, to explore this, we're joined by the founder of leading national buyers agency, Rasti from Get Rare Property. So welcome back to the show, Rasti.
Thank you so much, Bashir. This topic is so much meaningful to me because, there's so much opportunities out there and then we keep missing if we think too much about it. Something we know, analysis paralysis.
Totally agree. Absolutely, it's a really good topic to dive into, because I don't think many are really aware of the true cost of delay. So to kick straight into it, Rusty, what are the long-term financial impacts of missing out on a prime property investment during a market upswing?
Sure. Before we really go into it, if that's okay, I'll share a fun fact. In year 1980, the Australian national housing median was $76,500. Let me say this again, $76,500 in 1980. Now, knowing that in 2023, after 43 years, the same matrix, Australian housing median across the country is $770,000. So it has gone 10 times almost.
Yep.
Now, I actually tend to ask this question that if we had the way to ask our parents, our grandparents, or ourselves, if we were around, how many properties we would have bought in 1980, knowing the fact that it has gone 10 times in 43 years. And because I do this on a regular basis as educational programs on Zoom or in person, I typically see lots of hands going up. And the answers that I get, like how many property would I have bought, the answer is as many as possible, even to the extent somebody said the whole Australia if I could. Now, if I really talk about that number, if you think about it, it's not really out of context here, because now in 2024, we can safely say, I mean, of course, with a lot of question marks around it, that by 2066, as in another 43 years from now, the Australian housing median with the same rate of something called extrapolation, the median will be 7 million plus. If you wanted to buy that many properties in 1980, we should be thinking about buying as many as possible even now in this market. And of course, the caveat is that, oh, really, the growth might continue. But let me tell you that the capital growth rate between 1980 and 2023, the numbers that I've quoted, is not really out of the whack. It's actually just under 6%. It's 5.5% capital growth. And where we are sitting ourselves, that's pretty normal. I mean, that's really goes back to the history of the housing market that we have been tracking, or the AMP Capital has been tracking. It's about that number. So it's not really out of ordinary for us to think about the average median. I'm not really talking about the quality purchase. I'm just saying, if you just throw the hearts on the board and you just pick randomly few properties, we are probably getting close to the average. But of course, with the right research, with the right due diligence, we probably are picking the better half of the growth, as in, because median is median, right? It's right in the middle. That means 50% properties have done better, 50% have done worse than that number.
Yeah.
So in the search of finding the right property, what we have found actually is that people miss out on getting the right exposure in the right time. As
Yes.
I said, there might be excuses, but let's not forget the reason why we are buying is for that growth, that kind of a financial security that property or a growth asset would give. And it really comes down to the point that, coming back to your question, that's a huge potential of capital gain loss we are making, because when we don't have that exposure. It also means that when we have an intention to build a portfolio or buying few properties, the success of the first one, because with the power of compounding is one thing, but then the second thing is that we can extract the equity out, to go and buy the next one and so on and so on. So the delay, which might feel that, oh, we missed out on that, might not seem too much because they do not know what they missed. So sometimes ignorance is a bliss to feel good. But suddenly there is a missed leverage opportunities. I mean, real estate is all about leverage. You don't need to have all the money in your pocket. We can multiply that little money that we have, that return on investment or return on cash is a lot more bigger. Then we can extract and they can multiply. Then there's a compounding effect. And then the whole thing is about impact on retirement savings, right? So sooner we can get it, sooner we can retire. It's rather the question of how much money I should have in the retirement. I would say, have that money now or sooner, then you can retire. So there's a huge opportunity and there's a lot of follow through. And I would also add that when we don't have that financial security, it's not just about the financial well-being. It's also, it has a lot more effect on the things around us. Like when we know we can get there, it's much more easy. As an example, if I have to catch a flight and I know my flight, or I need to be at the airport in 43 minutes exactly, and my GPS says that I'll be there in 20 minutes, as an example, not right? So I'm not on a panic mode.
Yeah.
On the other hand, when I do not know about my journey, I just need to travel, I need to be there, that might lead to the panic. And the thing where we really need to be mindful that there's a fear of losing money or the losing opportunity, that risk aversion or the loss aversion really plays a big role out there. So if we need to be mindful of what's on the other side, really, I mean, to me, that's really the big cost of missing out on the opportunities.
Yeah, beautifully said. And there's that old quote by Steve Jobs that comes to mind here, where we all overestimate what we can achieve in 1 year, but way underestimate what we can achieve in 10. And you've given us a great example there of buying a property in 1980 and 10 timesing its value on the median value today. There's countless examples of that being the case. So let's talk about the barriers now that's stopping people from doing, because as you and I both said many times, it's the start that stops most people. What are some of the common psychological biases that lead to these missed property opportunities, and how can investors actually overcome them?
A great question. So first of all, it's a fear of losing money. Lots of people are really keeping the money to themselves and thinking that this is the last straw and, we really need to make it work. And don't get me wrong, that is really the case. We really need to make every dollar count. But the anxiety around the loss, as you said, there's other statement that the psychology around losing $100 is a lot more powerful, the fear of losing it, compared to the benefit or the gain that we make with the same $100 is not the same, because we tend to give more weightage to the loss element. So we tend to forget that what it might mean if it grows in our favor. So fear of losing money. So it's about education, not like emphasizing on the potential of the loss as an opportunity cost really can help us with understanding of that bias over there. The other element is the overconfidence, that people have a tendency that they know the market, they can time the market, they are just waiting for the last interest rate to happen so that they can jump in the market without realizing that the other players in the market are also saying the same thing. And all of a sudden, yes, there might be, I guess, more money in the pocket for people, but then there will be less properties to buy. And all of a sudden, we are competing again. So lots of people think that they have they probably tend to they tend to be overconfident around it. Then the other element of it is the herding bias. They really like to think that what others are doing in the market. I've seen so many times that people tend to grow or go sideways as a herd or as a community. Like if somebody's doing something, that might be the odd one out to start with. But then all of a sudden, like the whole friend circle, the group, social group goes around it. And what sometimes really happen is that they want to see that everyone is doing it. They don't want to be missing out. Then they choose to jump in. Maybe sometimes a bit too late. So there's a fear of missing out at the same time, but maybe too late in the journey there.
Yeah.
Other element I would also say is that this anchoring is also happening. And what anchoring means is that we tend to get fixated. For example, we were evaluating some properties in Central Coast in New South Wales here. And what we were buying 2 years ago, is setting up the mind that, oh, those properties will let go at, say, 500K. How can I go and buy it now 650 now?
Yeah.
So because there's an anchoring there. So the way we can get away with that is to understand and the focusing on the education, looking at the long-term historicals, the trends, and not just for the pricing, but also what's really the fundamentals of property investing, the supply and demand. Having understanding of that really helps us with those. And then there's a confirmation bias. Sometimes we say that, okay, I want to do something, and then there's a bias there that I might ignore all the negatives around it, but all of a sudden somebody says the same word, I'll really get excited about it. It's like if I'm running blue Tesla, I will start seeing all the blue Teslas around there.
Yeah, no, very well said. So to sort of look at this in context, then, how should investors actually approach the property market differently in order to avoid missing the opportunities in the future, considering current trends and market data then, Rasti?
Yeah, so the way I would say is that it's the key things to be staying informed, having to understand, like having the clarity that what's happening in the market. Market is dynamic as well. Like we have been buying a lot of properties in, say, Perth market. What we saw the market about a year ago is not the same market anymore because other investors have woke up. And again, I'm not really saying that we should not be buying there, but now it's being the mindfulness of which pockets we should still be considering and what pockets we should let go. And again, it's really at the reasonable price or not. Because sometimes we might say, again, there's an anchoring coming in, like we were buying those properties at that price, should we buy it now? Of course, there's an element, but if we stay informed to the fundamentals of property investing, I guess the other part of it is like staying true to your investment criteria.
Yeah.
Like having that investment criteria is the first thing, and then staying true to it is also, I guess, a very important element to it. As an example, if we are going for auction, we tend to write a number on a paper that we have to go by on this number, if at all, we have to buy this property. And our mandate is now that buy this property if it is lower than that, or let go the property. So setting that investment criteria is very clearly rather than becoming emotional, because that is the whole biases are all actually emotional. Yeah. So if we let the emotion come into play, especially for an unsupported investor who is really going against the sales agent on their own, they tend to become emotional because they have spent 3-4 months already to look for a property. And once they find a property, they are like, I really need to get my weekends back, not this domain.com.au or realestate.com.au all the time on my laptop, but I really need to go and get a life. With that element, there's a risk of like people are feeling the pressure of missing out. Then they also know it is really going up and up and up. So there's a catch-up game. So being informed, having that clear set criteria, sticking to it, I guess being prepared as well. Like sometimes the properties will come and go very quickly. So we have to be very prepared very quickly in the market like this. Market will come and go very quickly. So can we really jump on the opportunity? Building some networks around it. So I guess it's all about continuous education around it. Like, can we really understand how the market is moving? What are the biases? Being mindful of those biases, being mindful to the long-term strategy, and also knowing what investment criteria will work for me. I guess it really comes down to having a long-term perspective of things. Yes, we might have to pay a premium to buy the right property, but when we know the performance is such, can we really make a compromise? Not really overly pay a big amount of price to a property, because you and I know we make money when we buy the property. So it's about having that emotional control, having that controls around it. And I guess the best way to do it is to work with the professionals who know this, who are doing this on a daily basis, more as a system rather than emotional investors.
Yeah, beautifully said. Look, it's a topic we could talk more on, and we will in the future, but I really want to thank you for these quite timely and eye-opening wake-up calls, Rasti. And we suggest that anyone interested in taking their property investment to the next level joins you on one of your free upcoming Fast Tracking Your Financial Freedom live Zoom workshops by registering at your website on getrare.com.au/property investing for passive income, which again we'll have in the show notes. So thanks again for coming on the show and sharing this with us today.
My pleasure. Thank you so much.
Thanks, Rasti.